getting pretty close to tax filing time, and that got me thinking about transactions from last year and how to nullify some of the transactions that will be taxed. I don't like to pay tax. Taxes are a forfeiture of wealth. But the nice thing is that with an understanding of the tax code, you can use the rules to your favor and pay little or no taxes on investment gains. Some of you will remember the video that I put out a little over a year ago titled The Mythical 28% Collectibles Tax. If you haven't seen that video, I suggest you search for it and watch it. It's a rather painful exercise that I went through to demonstrate that the precious metals are not really taxed at a flat 28%. They're taxed as ordinary income. The 28% is a cap on the tax rate that you will pay. Understanding this is important. There are other tax rules that you should be aware of, which you can use to actually increase the size of your metals portfolio. It works whether you are exchanging gold and silver back and forth or trading gold and silver occasionally for paper securities for speculative reasons. There is a trick that I've used in the past that I will be using again this year. I thought it might be helpful to some of you, and so I'm passing it along. I will be using my specific example because it will make the mechanics of how to use the tax code to your advantage easier to explain. I'm sure you'll be able to adapt what you see here to your own specific circumstances and benefit from it. Before we start the example, let me state for the record that this is an example of a speculative transaction on my part. My personal belief is that the primary way to grow wealth is to spend less than you earn and store the surplus in gold. I do not speculate with any portion of my wealth that would hurt me significantly if I lost it, and neither should you. But sometimes an opportunity will present itself that will allow you to profit using a small portion of your funds. With that said, let's proceed to the example. So here's a set of transactions I made last year. I decided in mid-May to do some speculation in the stock market because there were a few railroad stocks that I found to be particularly compelling in terms of value. I sold 20 gold eagles to obtain $25,760 to buy these railroad stocks. It was my intention to hold these stocks much longer than I actually did, but they increased in price fairly quickly, and I found myself with a roughly $3,700 paper gain after only 2 months. So I had a choice. I could either maintain my speculative position in the rail stocks, or take advantage of the good fortune and book the gain. I decided to take a quick profit. I sold the stock, and after reaching the end of the settlement period, I used the cash to buy back my original 20 gold eagles, plus a profit of 1 gold eagle and 11 silver eagles. Now, one might question what the actual profit was. From my standpoint, the real profit was 1 gold eagle plus 11 silver eagles, which, if using my guideline of 63 ounces of silver per ounce of gold, is about 1.17 ounces of gold. Compared to the 20 gold eagles that I put at risk, this was about a 6% profit. If we look at it in dollar terms, the gain was $3,725 on an investment of $25,760, or a 14.5% profit. Now, we'll talk about different ways of accounting for wealth in a few minutes, but for now, we should acknowledge that the IRS views this transaction through a dollar lens, and so it is the $3,725 that they will consider a taxable profit. No doubt my broker will be reporting this profit to them. At my tax rate, this will generate a tax liability of about $1,300, which, if I pay it, will reduce the number of gold eagles that I can afford to buy this year by 1. And in effect, it will reduce my profit from 1 gold eagle plus 11 silver eagles down to simply 11 silver eagles. And such is the nature of fiat money and paper profits. But there are games that we can legally play to not only keep the full profit, but to enhance it. Luckily, the IRS is here to help us increase the size of our metals portfolio. Here are some handy tips they published to help us do so. I'm not showing all of the tips here because they wouldn't fit on all one slide, but if you're interested, you can look them up for yourself. The keys for us here are tips number 4, 5, and 6. Hopefully everyone already knows that if you book losses in some transactions and gains in others, and they all net out to 0, that there is no tax to pay at the end of the year. Many, though, aren't familiar with the rules that state if your losses exceed your gains, you can actually deduct these losses against your earned income. If you are single, you can deduct $1,500 of losses against your income. If you are married, you can deduct $3,000. Thus, if you are married and you can show a paper loss of $3,000, you may be able to reduce your end-of-the-year tax liability on your salary by about $1,000 if your combined federal and state taxes are close to 35%. What is exciting about this rule is the implication for the person who accounts for their wealth in metal. Suppose, for example, that you have some gold eagles and the price dropped significantly from the time of purchase. You personally are excited about the price drop because you can buy more gold with your surplus earnings, but the tax code makes the price drop even sweeter for you. Why not go to your local coin shop and exchange the gold eagles for gold buffaloes or gold maples? You'll still have roughly the same amount of gold after the transaction, less the dealer spread, of course, but you'll also have a receipt from the broker showing evidence of a capital loss. If you report this loss on your taxes, then you will owe less in taxes at tax time and can use the surplus money to buy more metal. So not only will you have the same amount of metal, but you can use the phantom paper money loss to accumulate more real wealth. Let's explore how this might work using my real-life example. I'm a disciplined gold investor, and so I accumulate some money every month with my surplus earnings. So I'm sure there are some receipts back from the 2011-2012 timeframe that I can use to show a higher price on the purchase of the 20 gold eagles that I parted with in my speculative transaction. Sure enough, here's a transaction I executed on April 29, 2011, where I exchanged one form of rapidly appreciating real money for another. It was again a speculative transaction where I wanted to book some of my gains in gold, which is my preferred unit of account. So what this receipt shows is that the acquisition cost of the 20 gold eagles I recently parted with was $1,621 per coin for a total of $32,420. This is the cost basis for my eagles. Now, I sold the eagles in May for $25,760. This now creates a capital loss which can be used to offset the $3,725 speculative gain from stock trading. All totaled, I can now show a loss of $2,935 to the IRS, which according to their rules can be deducted from my taxable earned income. At my current tax rate, this will increase my tax refund by about $1,027, which is almost enough to buy an extra gold eagle this year. So to sum up, when you hold your wealth in something other than dollars, it allows the tax code to be used to your advantage. What would have been reported as a several $1,000 gain can now be shown as a paper loss. But is it really a loss? My metals portfolio increased by 1 gold eagle and 11 silver eagles. Plus, I will be getting a tax break of a little over $1,000, which I will put towards the purchase of another gold eagle. None of this is to say that I won't be paying taxes. I pay plenty of them, believe me. But I don't personally want to pay any more taxes than I'm legally required to, and neither should you. So I hope this little example has proven to be useful to you. Please feel free to ask questions.